Personal Finance with Warren Ingram.
Warren Ingram, who is a personal financial advisor. He is an executive director at Galileo Capital. He is an author of not just one or two, but 3 books. And I see on my little list of treats and surprises that we're going to be talking about your book more specifically coming up on Monday evening, Warren, your global investing book. And I think that's going to feed into some of what we're going to talk about tonight. But I see you getting lots of traction. Lots of people are talking about your book. Lots of people are excited about your global investing book. Congratulations.
Yeah, thank you very much, Bruce. And I just got the sales for the first month, which was September. And certainly out of the 3 books, it's the one that's had the biggest launch. So that's very exciting.
Fantastic.
And I'm very grateful that someone actually wanted to read it. So I'm thrilled. Thank you.
Yeah, I mean, people don't read books. They buy them and they put them on their shelves and they look busy. And the smart ones break the back of the spine a little bit to make sure that it looks like it's being read. And just for the record, just checking in on you here, the Serendipity Trust, which is a trust that you and your wife Vanessa set up many years ago, and has been a beneficiary of the first 2 books, royalties. I take it that book 3's royalties are going into the same trust and will be used for the same purpose.
You are quite right. We can't say it like that, unfortunately, because there's a funny thing in our tax act that where you're a charity and you earn royalties, which is what I did in the first 2 books, where I made the royalties go directly to the charity. Once they go over a certain amount per year, then SARS decides to tax that as income, and so then it ruins the purpose of the charity. Getting the income without losing half of it to SARS. So, I mean, there's a bit of a technical thing, but the point is I'll get the revenue, then I donate it to the charity so that the charity doesn't pay tax and I pay tax. So, yes, but just a kind of roundabout way of doing it.
Anyway, it's good that it's going to charity, and that charity helps educate young people in nice schools. And I think 1 person in university, 2 people in university.
Yeah, 1 in university at the moment and 1 at school.
Fantastic. Lovely. Nice to see. Now, listen, we need to talk tonight about how you can earn income from investments. Now, interest rates are low. They're likely to go up, but they're not going to rocket up unless something dreadful happens. Traditionally, people are sort of dependent on putting money into money market accounts and getting quite competitive interest rates, and they put money into property funds because the rental income has been very, very lucrative. But that sort of old school strategy hasn't worked for the last 18 months, 2 years. It was coming under pressure anyway. How then do we start ensuring that we can generate income from our investments so that we can cover the cost of living?
You're right about the old school part of it. And the difficulty there is that a lot of the people that are relying on that income are people that, on the other side of 55, and so they're not that keen to adapt, their strategies that they might have had for many years, if not a few decades. And so these low interest rates are burning them terribly. And then, the kind of the collapse in the property market, and especially where property funds have, stopped altogether paying out income to some extent, whether it be for 6 months, 12 months or 18 months, has been really punishing to these investors. And so I think, the first point is to try and get them to understand, that you can't really look at income from investments in a traditional way. For example, a lot of entrepreneurs would say, when I invest my money, I'm happy to let the money grow, but I'm only going to take the cash that the investments generate, much in the same way that they would, their business. They would have said, I'm not going to sell capital assets out of my company. I'm only ever going to take the profits. The thing about investing is that you can actually take money from your investments to fund your lifestyle in the form of just regular withdrawals of your capital. And really basically, just really simply, you put money, let's just say, in a balanced unit trust. And you say, well, I know the average balanced unit trust in South Africa is probably only going to pay out an income now of about 2% a year, which is certainly not going to be enough to cover most people's cost of living. But what they also know is that the average balanced unit trust in a normal year will probably grow at about 10% a year. So if you're in a situation like that, the mindset changes to say, well, hang on, let me, draw 4% of the capital growth every year. So 4% from my capital, knowing that, if the capital's growing at 10% in total, I'm leaving behind 6% a year. And that should account for inflation and the rising cost of living, which is always there. And if I keep drawing the 4% every year and I get the growth, then, all in, I'm still in a good position. And I don't need to worry too much about actually the physical cash that the fund is paying out, because I'm really focused on capital growth now. I'm not so focused just on the income. And I think that's maybe the big mindset change that people need to have now is try and look at things a bit different to what you would have done over the last 5 years or even 3 or 4 decades. The world of low interest rates is, I think, going to be around for quite some time. And I'm wondering, like many of us are, what we will get from property funds in the future. I suspect it's not going to be back in the 10, 11, 15% income that we've seen in the past. I think it's going to be low for quite some time.
Yeah, and it's our reality. It really is. And that idea of growing the value of your capital is something that is an anathema to people who were retiring 10, 15, 20 years ago, because you started de-risking from the age of 55 because you were going to retire at the age of 60. And so therefore you took your money out of risky assets, so-called risky assets of shares, and you started putting it into fixed interest. And so you knew exactly on the day that you retired, you would have enough money to last X amount of time. And I think that's been proven to be very, very risky in its own right, because the moment you take no risk, you don't get growth.
Exactly right, because now you get exposed to the slow poison that is inflation. And the problem with inflation is, you and I won't be, shouting from the rooftops to tell everybody, watch out, your cost of living is rising, the buying power of your money is declining, because it is. It's just a slow, gradual erosion of the buying power of your assets, of your investments. And actually, you only really feel the impact of that in, quite a few years down the line, when one day you kind of almost just look around going, gee, I can't really afford to buy what I used to buy. I mean, I have more rands in my pocket, but those rands are not stretching as far as they used to in terms of being able to buy the basics. So understanding that inflation is a reality. Yes, we will be in a lower inflation environment for quite some time, and that means lower interest rates, but you still need to account for inflation. And unfortunately, the only way to really beat inflation as an investor over long periods of time is you have to own what I would call productive assets. And productive assets would be things like shares and property companies that have a history of beating inflation over 10, 20, 30 years. And unfortunately, yes, it does come with a bit of a roller coaster ride, because you'll get years where we see fantastic growth and the markets jump up and your share portfolio jumps up 20%, and you feel like a legend. And then 3-4 years later, you see it dropping by 30% and you feel like a pauper. But just to understand that over long periods of time, those productive assets are the ones that are going to protect you. And I think also just to understand, there are quite significant tax benefits to being someone who lives off your capital rather than off the income from your capital. Because generally, if we earn interest or we earn rent, we're going to pay income tax. And if you're wealthy, that could be, you could be giving away as much as 45% of your income every year to SARS. And, you might want to do that if you're a generous person, but for the rest of us, we want to pay as little tax as we legally can. And understanding that if you're selling capital and realizing some capital growth, you're paying capital gains tax. And at worst, that's going to be 18% a year. Now, I don't know about most people, but for me, I'm happy to pay the 18% instead of the 45%. So there are some benefits to changing your mindset when you look at this problem we have now of low interest rates. But just know that it comes with a big roller coaster ride, and it's not nice and predictable like you would get on your money market funds and your fixed deposits. But certainly, I think, over a 20, 30-year period, focusing your portfolio to have more of your capital invested in those productive assets will certainly be better for you to beat inflation, save some tax, and I think eventually live a bit more comfortable life than stressing about trying to earn 3, 4, or 5% a year on your fixed deposits and chasing around to find the ones that are going to give you the best return in a just awful environment for cash investors.
Thank you for that, Warren. We got a question from Richard, and Richard sent us a mail and says, I am a disciplined investor. So immediately he gets 2 ticks in Warren's little black book. I'm a disciplined investor and managed to consistently build up my portfolio over the last few years. I've been working towards building the offshore allocation of my portfolio and getting my asset allocation right. Highfalutin talk here from Richard. But given the concerns around US inflation and the possible impact on markets, I'm not sure of the best approach. How should I be approaching my investments? Should I build up my cash until the storm is over? That is a question from Richard. It's got all the offshore stuff that you have been studying so very carefully to put into your brand new book, Warren. So are you going to draw, no doubt, on some of that information? You're going to draw on it because it is built into you now, and it's fresh in your mind. And we're going to tackle Richard's question in a moment here on The Money Show.
The Money Show.
Personal Finance with Warren Ingram.
Richard is disciplined. Richard is consistent. Richard has built up a portfolio. Richard wants to get his asset allocation right, but he's worried about all the noise that is in markets at the moment and the impact that the noise could have on markets. And he really doesn't know what the best thing is to do. So he wants to take some cash and stick it under his mattress. I'm summarizing. Warren, what do you think of Richard's question?
I must say, I'm loving Richard's question. There's so much there that makes me think he's been listening to you and I talk for quite some time already over the years, and I think so. Maybe just to touch on the points, being disciplined with your investments and having a focus on the asset allocation. In other words, the combination of cash, bonds, property, and shares. Brilliant. I mean, that's actually the key in all of the big investment decisions. If you can get your asset mix right, you've kind of won the game already, and all we're waiting for is the whistle to blow to tell you that it's over and you're the winner. But where Richard's falling down a little bit is unfortunately around the question of, do we wait because there is a reason to be fearful? There's a reason that investments might go down. And in this instance, he's talking about US inflation and the possible impact on markets. Unfortunately, Richard, there are always going to be reasons to be fearful about investing. There are always going to be, there's going to be a crazy, president in some country wanting to drop a nuclear bomb, or, some government trying to overregulate or underregulate, whatever it is. There will always be a very good logical reason for you to be concerned. And so then, deciding to wait for things to get better, waiting for the storm to pass. Unfortunately, what happens is that the storm passes right about the time that the stock market peaks again. So in other words, the stock market doesn't start to recover when things are over and when the storm is over. The stock market starts to recover when things are really rocky and terrible and everyone's still afraid. But some people have started to figure out that things are cheap, investments are cheap, and they start to buy. And then they keep buying and the market builds up momentum. And then, everybody else figures out that the market's now, on a great roll and they buy in. And right about then is when things are better, when there is no reason to be afraid anymore. And that's probably when the market's about to fall again. So my advice, Richard, is, 2 things. One, if you're sending the money from rands to dollars, pick an exchange rate that works for you. And whenever the exchange rate is better than that, send the money out. In this world, in this environment, what we know about South Africa and the world and everything else today, I'd be saying somewhere around 15 Rand 50 to the dollar is my level. So when the Rand is at 14.90 or whatever it is, then it's a great time to send the money out. And don't try and time it better because you can't get it right. No one can. And then when your money is overseas and you're now deciding to commit to the global markets, just feed it in over 3, 4, 5, or 6 months. If it's $100,000, say, well, it's 100,000. I divide it by 6. And I committed to my investments over 6 months in equal parts. And then close your eyes when the markets are doing what they're going to do until you're fully invested. Then wait a year and look at your statement for the first time, because the markets are going to drive you crazy if you try and predict them. And they certainly are going to go up and down all the time. But hopefully they go up over long periods of time.
And again, past performance is no guarantee of future performance. T's and C's apply. Right. But history shows, and you can look at any graph over any period of time. And generally, we say any period of time, any 5-year period, any 10-year period. And other than South Africa in the lost decade, stock markets generally go up. And then when things recover a little bit, they make up for lost time, as we have seen quite substantially in the last 18 months or so. Finally, let's wrap up with a question. There's a sign. It's blue. It's got a red rim and a blue triangle on the inside. It's not a stop sign. It's a yield sign. It means pause, look left, look right, and proceed if it's safe. But that's not what you're talking about. What is yield when it comes to investments?
Yeah, it's got nothing to do with that, Sal, I promise. So yield is basically the income that we earn on an investment. So for example, if you've got a rental property, then the yield is the rent that you are earning on the property. If you've got a money market account or a money market unit trust, then it's the interest that you are earning on that investment. And it's usually explained as a percentage. In other words, you've got 100 Rand invested and you're earning 5 Rand from that, then the yield is 5%. And typically that's what investors will focus on when they're making an investment decision around income is what is the yield? Am I getting a good yield or a bad yield? Very typically spoken about in the bond markets where investors are really focused on that yield and making sure that they pay the right price to get the right set of income. But in general, that's going to be the deal is what sort of income am I getting from my investment? And it could be a dividend yield if it's a share and it's paying out dividends, or interest yield or bond yield or rental yield on a property.
Asked and answered, as always, on a Thursday at this time. Warren Ingram, personal financial advisor, executive director at Galileo Capital, back in the studio to chat to us on Monday about his brand new book on global investing.